BigBear.ai Holdings, under ticker symbol BBAI, closed its latest official trading session on Friday, June 12, 2026 at 4:14 p.m. Eastern Time at an exact closing price of 4.14 USD per share, marking a positive intraday upward movement of 2.99% during the regular session. This session saw a high of 4.22 USD and a low of 4.05 USD, demonstrating the typical active trading behavior that retail and institutional participants have come to expect from this particular asset. In the subsequent after-hour session, the equity ticked slightly downward by 0.5% to sit at 4.09 USD. What the general trading public does not realize right now is that behind this stable $4 price level lies a massive structural change that took place at the 2026 annual meeting of shareholders. Investors voted to approve an amendment to the Certificate of Incorporation that officially doubles the number of authorized shares of common stock from 500 million to a staggering 1 billion shares. While retail investors frequently look at a positive 3% daily gain as a sign of immediate health, the reality is that the corporation just laid the groundwork for massive equity dilution or potential large-scale capital raises. This creation of room for an extra 500 million shares signals that management is preparing for major actions that could fundamentally alter the value of every individual brokerage account holding this asset. When people look at an asset like BigBear.ai, the common ground of investor sentiment is usually centered on the idea that any company with those two letters in its name must be an automatic winner in the modern technology landscape. The expectation is that because they secure defense contracts and work alongside massive federal entities, they possess an unshakable foundation for immediate financial expansion. However, the reality of the balance sheet challenges this perspective quite aggressively. While the broader public assumes that federal software providers enjoy infinite scaling capacity, BigBear.ai has historically struggled with flat quarterly revenues and deep net losses. Retail traders utilizing standard investing sites often buy into the narrative of government integration without realizing that defense procurement cycles are notoriously slow, highly bureaucratic, and occasionally erratic. To truly understand where this equity is moving, we have to look closely at the trading volume and recent market mechanics. The daily trading volume has shown distinct spikes that contrast heavily with its historical daily average volume of over 51 million shares. When volume drops down to around 11 or 12 million shares during standard sessions, it indicates a consolidation phase where larger institutional players are observing the retail float. Retail trading apps like the Robinhood app or platforms like SoFi Invest frequently show this company among top trending small-cap technology assets, yet institutional ownership data tells a much more conservative story. Larger asset managers using interactive brokers trading systems have treated this asset with caution due to its high price volatility, which has seen the stock lose roughly 35% of its value over the trailing 6-month period, despite individual green sessions. The pressure on this specific equity is heavily tied to macro conditions and the changing landscape of self-investing. When individuals look for investment help or use advanced platforms like Schwab Intelligent Portfolios, they are increasingly looking at whether a company is burning through its cash reserves or generating authentic positive free cash flow. In the case of this firm, the recent shareholder authorization to increase the share cap to 1 million highlights a defensive corporate strategy. If a company requires the contractual right to issue twice as many shares as it currently has outstanding, it is generally preparing a buffer to preserve liquidity through equity issuance rather than relying entirely on operational profitability. This creates an immediate tug-of-war on major platforms like Fidelity Investments or when setting up individual allocations through specialized Fidelity IRAs. Let us discuss the underlying operations, because understanding what this enterprise actually does is essential for anyone engaged in online investing. The organization specializes in providing machine learning and automated decision intelligence solutions across 3 primary verticals: global supply chains, autonomous infrastructure, and advanced cybersecurity. Unlike standard software enterprises that sell consumer products, their main clients are the United States intelligence community, the Department of Defense, and specific high-level logistics operations. For example, they recently announced a foundational agreement to deploy their automated cargo security management infrastructure with Panama Transshipment, showing a deliberate effort to expand beyond pure government dependencies into broader commercial logistics networks. This brings us to the operational history and why older financial reports continue to impact current market valuation. The firm was originally founded back in 1988 and operated for decades as a professional services consultancy before transitioning into an entity focused on scaling advanced software analytics. This legacy structure means they still carry a heavy burden of professional service costs, which carry much lower profit margins than pure software-as-a-service enterprises. When people evaluate technology options through a standard Fidelity brokerage or a Robinhood stock trading account, they expect software profit margins to hover around 70 or 80%. For this firm, the real-world performance has been heavily weighed down by the labor-intensive nature of customized government integrations, which keeps their overall margins compressed and historical net earnings deeply negative. Take a moment to join the discussion on this structural change. Comment below how many shares of BigBear.ai you currently hold in your portfolio, or share your thoughts on whether you think doubling the authorized share count will lead to immediate dilution for smaller investors.
Looking forward, the future outlook for this asset depends entirely on the tension between what the market expects and what the operational reality can deliver. There are two distinct paths that could unfold over the coming quarters. The optimistic scenario involves the company leveraging its massive backlog of defense contracts and turning its newer commercial logistics ventures into rapid cash generators. If the Panama logistics deal and similar commercial initiatives scale efficiently, the corporation could theoretically hit its full-year guidance targets without needing to tap into that newly authorized pool of 500 million shares. Under this scenario, users tracking the company via SoFi Active Investing or high-level Fidelity trading platform software might see a steady recovery towards previous multi-dollar resistance levels as short sellers cover their positions. Conversely, the risk-heavy scenario is one that retail investors using online investment tools must carefully consider. If government contract extensions slow down, or if the adoption of their autonomous system solutions faces regulatory headwinds, the corporate entity will likely utilize its new legislative authority to issue additional equity. Doing so would instantly delete existing shareholders, lowering the intrinsic value per share even if the overall market capitalization stays the same. When individuals participate in self-investing through Robinhood fractional shares or individual accounts on mainstream investing sites, they often overlook authorized share capital increases until the actual secondary offering hits the wires, causing an immediate drop in price. The broader macroeconomic environment adds another layer of complexity for any tech asset trading in this price tier. With interest rates staying structurally sticky and institutional capital showing a strong preference for large-cap balance sheet stability, small-cap technology firms are under intense scrutiny. When wealth managers utilize frameworks like Fidelity Wealth Management or automated asset allocators like a SoFi robo-advisor, the algorithms are typically programmed to reduce exposure to companies with negative price-to-earnings ratios and high historical volatility. Therefore, the equity relies heavily on the continuation of retail momentum to maintain its current floor above the $3 mark. When we synthesize the current state of this technology asset, the contrast between expectation and reality is starker than ever. The public expectation is built around the allure of a small-cap firm deeply embedded with national defense and autonomous infrastructure, driving short-term trading excitement on popular retail systems like the Robinhood app or the SoFi investing interface. The underlying reality, however, is dictated by a massive new corporate authorization to double its potential share count, historical financial results showing flat revenue growth, and the complex challenge of migrating from low-margin advisory services to high-margin software delivery. For the long-term observer, navigating this asset requires looking beyond the daily 3% green closes or the promotional posts on public social feeds. The actual health of the stock will be determined in the upcoming quarterly reports, where the exact state of the contract backlog and the potential utilization of the new share pool will be laid bare for anyone checking their statements through Fidelity mutual funds, Interactive Brokers platform tools, or any modern individual brokerage. Keeping a close watch on these specific financial metrics remains the only logical approach to managing risk in this highly speculative pocket of the public market. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Passport backs. Don't forget to like, comment, and share this video to support the channel.